Raj Trading. This is Raj Sastry. Today we'll talk about long put. It's also called, buying a put option. So we will quickly talk about, you know, some considerations. So what is a put option purchase? A buyer of a put option has a right to sell underlying asset at the strike price till expiration date. A trader may buy put option when they are bearish on the stock. Price of put option increases as stock falls below the strike price. So why buy put option? So if you're believing the stock will fall and you have bearish outlook, that's when you buy a put option. And you can protect your downside of a stock that you own. For example, you already own a stock. You are afraid stock will fall down in price. You can buy a put option. And sometimes you can also buy, just a put to speculate and make money when the stock falls. Maximum profit potential reached when stock price goes all the way to zero by expiration date. The maximum loss is the premium that you already paid. You cannot lose more than that. When to buy puts? When you're buying a put option, make sure trend is downward and also identify a clear area of resistance above current stock price. And also make sure volatility is relatively low because when the volatility is high, you are paying a high price to purchase put option or any option for that matter. From a duration perspective, generally, 90 days or above is a good idea because the time decay works against this position. And strike selection perspective, make sure you around say 60 delta or 70 delta or a clear area of resistance above current stock price. And this is a quick illustration of buying a long put. So in this case, we have a stock which is trading at $40. That's the current stock price. And we identified a clear area of resistance at 45, which is above the above current stock price. So we are buying a put option at $45 strike price for 90 days out. So we pay $2 for that. So currently, the maximum that we can lose is $2 or $200, which is times 100. But if the stock, decreases in value or falls in value, we can basically make more and more money. So maximum profit is when it goes all the way to zero. This is when you make most money and you basically, make much more than what you paid. But instead, if the stock increases in value, for example, it goes to 50, 60, the maximum that you will lose is, the premium that you paid. In this case, it's the $200. And also, these few concepts, at the money option is, when the current stock price is 40 and, you buy a 40 strike option that's at the money. But in this case, if you buy a stock price, for example, 45 or 50, it's in the money because it's a put option, it will become in the money. But if you buy something below the current stock price, a option strike price below the current stock price, that's out of the money option. Just a quick terminology here. And then we'll go into some key considerations. So you're buying a put option because you want to profit from decline of the stock price. Some of the con is really if the stock stays above the strike price at expiration, you will lose the premium that you paid. So some things to mitigate from a mitigation perspective, buy option, put option at a clear area of resistance. Avoid some high flying growth stocks that can, increase their price exponentially. And a cheaper alternative is to buy a vertical put spread instead of outright purchase of a put option. So avoid stocks that are really trending up. There's accelerating revenue growth and there's a margin, increase. It has a low debt level, and some of these acquisition targets like tech or a biotech startup. And watch out for decrease in volatility. Normally, when the volatility is low, that's when you buy these put options, but you don't buy when it's high. And when the stock price raises above your strike price, better to cut your loss and sell your put option, so that way you don't get into too much loss. So with this, next we'll go into think of swim platform to illustrate buying a put option purchase. For that, we will select a stock which is a trade desk, or a TTD, the symbol, and we will go above 90 days, which is in this case 115 days, and we will basically choose a 61 strike price. In this case, I mean, sorry, 110061 delta. The reason we kind of chose is really, if you look at trade desk, it's going up and up and up. So it's right here at 963. We feel it went up dramatically. We feel it might come down, and we also identified, as you can see here, the volatility itself is really low right now. It could be good time to buy the stock. And as you see here, the DI plus is kind of trending down, meaning that there may be some bearishness coming. And also, if you look at the Chaplin money flow, it's kind of trending down. So we feel there may be a chance the stock might fall. So that's why we initiated this position. Let's go back here. We are at 62 right now, 62, 60 delta. We'll go and buy a put option here. We are paying $214, which is um, $21,000 to buy this put option. We got it filled. Now let's go all the way to December 30th and see how is our put option position doing. And it will take a while to buffer. In the meantime, let's look at the chart. So as you look at the chart here, stock is kind of coming down, in price. And also, as we see here, the volatility is increased a little bit. And if you see your DI plus, which is the green line, sorry, blue line here, it's trending down, and the DI minus, the red line, is going up, which is a bearish sign for the stock. With that, let's go back to our monitor tab and see how is our put option doing. So looks like here we got a put option. We made around $9,800, and we got two put options here. Let's close both of them out for a nice profit here. And one more. All right, so just to sum it up, what did we learn here? What we learned is really, when you buy a put option, make sure you buy it at a higher price, go above the current strike price, identify a clear area of resistance, and buy the put option when the volatility is relatively low. So we bought around December 22 or so. Volatility was low at that time, and we saw some bearish signs the stock might go down. And in this scenario, because we also looked at the delta position, and we went around 60 delta put option, so which is a really above current stock price. So this is a good way to profit from a falling stock, and you feel stock price will accelerate so much it will fall down. This is a very good strategy, and maximum that you lose is what you paid, so you can't lose more. With that, thank you very much. Happy trading.